All right, well, let's go ahead and get started. Thank you for joining us today for today's Zoominar on new tax rules for 2023. It's my pleasure to introduce my business and life partner, Carl Frank, who will be our speaker today. I think you'll find Carl's presentation full of lots of interesting facts. Carl's got a great flair for making the complex simple and distilling a lot of complex information in nuggets that you can easily remember, and even throwing in a dash of humor here and there. So without further ado, it's my pleasure to introduce my husband and partner here at A&I, Carl Frank. Carl, hand it over to you.
Thanks, Stacey. That's very sweet of you. Thank you, Stacey. Welcome, everybody. My name's Carl Frank, president of A&I Financial Services. And today we're going to talk about new tax rules for 2023. Please note, we are recording this, and so to keep everyone's privacy, we've made you invisible and we put you on mute. You may still ask questions. We encourage you to ask questions. To do so, use the chat menu. At the bottom of Zoom, just click chat and type your question in the window that displays. Today is Groundhog Day, made famous by Bill Murray in the great movie Groundhog Day, in which he relives the exact same day over and over and over again. So in honor of that movie, I thought I would welcome everybody. My name is Carl Frank, president of A&I Financial Services. Please note that we're recording this. Oh, I'm just kidding. We'll get started now. Thank you so much for joining us. We're going to do our best to make taxes interesting. There were a lot of changes last year. Our next couple of events I'll announce right now, and I'll repeat them later. On March 16th, we're going to have taxes again with Chris McGovern. Chris comes from Transamerica, so he's got a lot more resources than we do. I think he's also an attorney, so you have a different perspective on the tax law changes and some planning you might want to do for 2023. And then on June 1st, we're going to have a person in-house again. So we're going to start our in-person meetings at our new beautiful offices. Understanding healthcare costs with Dr. Bill Lloyd. I've seen Bill speak. He's fantastic. He's an octogenarian, and he knows about what it means to have healthcare expenses when you're in your retirement years. Please follow us on LinkedIn, like us on Google, like us on Facebook, follow us on YouTube, and subscribe to our podcast, The Expert Network Team. Check out the resources on our website. On our website, you'll find an archive of all of our previous Zoominars. Soon, we're going to post this one up there. And so check out the videos. You can find an archive of all of our podcasts. And if you haven't already, sign up for our Periscope email newsletter. We have content unique to the Periscope email subscribers, not available on the website. All right, without further ado, let's dive into today's presentation. Tax changes. There are 90 different changes that were made at the end of 2022 in an act called the Secure Act, Setting Every Community Up for Retirement Act. And it was big. And 4,000 pages. I divided them into 3 categories for folks, and we're going to start with the biggest changes, the ones that affect the most of us, I think. And I hope you feel the same way. We're not going to dive into all of these. There's no possible way I could do that. But we'll keep it high level and do my best to keep it interesting and simple as well. So the first ones affect retirees, then we'll talk about what's affecting workers, and then we're going to talk about changes for everyone. The biggest change that affects a large number of people is that they once again changed what's called the RMD, the required minimum distribution. So if you have a tax qualified retirement account, an IRA or 401k or other type of tax deferred retirement account, then you are forced to pull the money out at a certain age. Now, Roth IRAs are exempt from forced distribution, but all of the tax deferred types of retirement accounts have to follow a required minimum distribution age. And the easiest way to make these changes memorable is to think about the 1950s. So many of us remember that just a few years ago, the required minimum distribution age was 70 and a half, and it's memorable because it was so weird. 3 years ago, approximately, they changed it to age 72. Last year, for this year going forward, it depends on when you were born. So if you're already taking a required minimum distribution, it didn't change. You don't get to punt. You keep it at age 72. But if you're born basically in the 50s, between 51 and 1959, the year of your birth, then you get to pull it out at age 73. So some people who are turning 73 this year get to wait another year, or turning 72 this year would get to wait another year until they turn 73 next year. For all the rest of us born 1959 or later, our RMD has been punted to age 75. So not all tax rules are always bad, right? Not all changes to tax always increase. This is one that reduces our taxes because it doesn't force us to pull money out of IRA accounts where when we make a withdrawal, we have to pay income taxes on that withdrawal. This is a good change. Just think about the 1950s, date of birth between 51 and 59, then you do have a required minimum distribution at age 73. But if you're younger than that, it's age 75. And if you're already taking a required minimum distribution, you have to continue. All right, so that's the first big change that affects the most of us. The second one that's going to affect a lot of us on the call were changes to the qualified charitable distributions. So from an IRA, you can make a QCD, a qualified charitable distribution, directly to a charity. Neither you nor the charity pay income tax. So it's very nice. And the limit to that is $100,000 every single year. So you can make a number of distributions, if you like, to a number of different charities. It has to go directly to the charity. A couple things made them a lot more appealing this year. First, QCDs are now indexed for inflation. So that $100,000 limit is going up every single year by the rate of inflation. So beginning next year, you'll be able to contribute a little bit more than $100,000 a year into it from your IRA directly to a charity. The second thing that's a little bit complicated and sounds really exciting up front, but could be too complicated for people to use, is that now you can make your charitable distribution into what's called a split interest investment. So that would be a charitable remainder trust, some sort of a charitable trust or a charitable gift annuity. Now that's limited to $50,000, and the amount of work that it takes to hire an attorney and set up the trust to make sure you stay compliant with the law might not make that appealing to you. But if that's something that you are interested in, charitable trusts, we've got a number of resources on our website, podcasts, as well as white papers about charitable gifting that might be appealing to you. So that's pretty good. And then finally, there's one big thing, though. This is mistaken, I think, often. A lot of people use a DAF, a donor advised fund, DAF, and there's a lot of advantages to using a donor advised fund or a DAF. You can put your money in now, get your tax deduction now, and then choose your charities later, but you can't do an IRA to DAF contribution. That's still prohibited. The QCD cannot go into a donor advised fund. Okay, the next big change, and this is very exciting for me, go tax-free, the Roth. In the past, Roth IRAs, Roth 401ks have been available. Now, there's a whole slew of ways you can go tax-free. Roth SEP IRA for self-employed people, Roth Simple IRA for small companies that are not doing 401k plans, a Roth 403b plan for charities, and a Roth 457 plan for government organizations. So now everybody almost can go tax-free inside of their employer-sponsored retirement plan. So that's a really big change. Another thing that's very big about the Roths, remember, like I said a minute ago, they don't have a required minimum distribution. So it used to be that a 401k did require a Roth 401k to have a distribution. Well, they made it a little bit more appealing for us this year. They eliminated forced distributions from 401k plans for Roth as well as deferred. So that's a very nice thing. You don't have to have your Roth 401k plan with a forced distribution any longer. That's a big change. So this brings a lot of planning opportunities that you should make a note and talk to your financial planner about. Like perhaps maybe if you don't already have a Roth, you want to start one. Now you can start one with just a few dollars. You don't need to put in, hundreds of thousands of dollars in there. And you can start one with a conversion. So regardless of your income limit, there are contribution limits. Your income might be so high that you can't contribute to a Roth, but you can convert from a traditional IRA into a Roth without an income limit, or into your 401k, you can contribute to a Roth without an income limit. And get it started, because there's something called a 5-year clock. And in an IRA, in the Roth IRA, not in the other plans, there's one 5-year clock that rules all of the others, like the ring in the Lord of the Rings trilogy. There's one ring that rules them all. There's one Roth IRA clock that rules them all. And as long as you start your 5-year clock in a Roth with just a few dollars, it doesn't have to be a large amount. In fact, after you start it, you could bring that Roth account down to 0 and the clock still starts. Then all of your other Roth accounts that you might accumulate over your working years can roll into that Roth. They'll never have a penalty because you've already used up your 5-year clock. Until you do that, you've got a 5-year clock for your Roth 401k at this employer. And if you had left one at another employer and never rolled it over, you get another one for that one. So you really want to get your Roth IRA started as quickly as you can. That's a planning opportunity. The other thing that's very important, that's a big change, and it affects employers more than employees, but employees will be able to choose this. And that is that in the past, an employer, the boss, if they put in a match or some sort of a safe harbor contribution, they had to always, every single time, put it into the deferred account. That's not the case anymore. So now, beginning next year, you'll be able to, your employer, they've got a year to figure out how they're going to do this. In 2024, the employer is going to be able to put their match and their safe harbor contributions, their own money, into a Roth account. And so that's very exciting for you. That means you can get more money tax-free than you could in the past. There's one more change, which is not exactly easy to understand. They're forcing highly compensated people to put their catch-up contributions inside their 401ks into the Roth. So again, last year, just a few months ago, if you were highly compensated working at an employer and you wanted to catch up in your retirement account because you're falling behind and you're over the age of 50 and you want to put more money in, then you had to put it in the deferred side. This year, they're forcing you. If you make more than $145,000, you have to put that catch-up contribution into the Roth side. The government wants its money out and taxed as soon as possible. So they're going to force your excess contribution, if you make more than $145,000, to go into the Roth side. It's, in my mind, a good thing. It's a little bit like taking your medicine, and you just do it and it doesn't taste real good. But then when you're done, it's over, right? You just swallow the pill. You swallow the tax pill early, and then the growth on the Roth is tax-free. The distribution is tax-free. If you're in an IRA, you never have that requirement distribution. Your kids inherit it tax-free. There's all sorts of things that are beneficial to doing the Roth over the deferred account. Their government is forcing us to do that. We can make up reasons why. I don't want to pass judgment on anything that goes on in the government, but one of the reasons that seems real common sense about why the government would want us to do Roth, if it's in our best interest, is that it's in the government's best short-term interest, that they can forecast all of these numbers and say, oh, the tax revenue hit isn't that bad to our deficit, at least over the short term. And by the time that those distributions are finally made tax-free, the government will find some other way to solve their problem. Okay, 529 plans. Now, 529 plans are for education. So if you or your kids or your grandkids or someone's going to go to college, and you can actually use it for post-secondary or secondary school as well, the 529 plan is a great way to do it. But they haven't been as popular as perhaps maybe some people want them to be. And this is a common story I hear from people that, well, I don't know if my kid or my grandkid's going to go to college. I don't even know if they want to go to college. I don't know if I want them to go to college. So they've been not as appealing. And so if you put a bunch of money into a 529 plan and the kid doesn't end up going to college, then you had limited options about what you could do. They reduced those limitations. Now, if the kid doesn't go to college, if you've got money left over in a college savings plan, you can roll it into a Roth IRA. You can roll it into your own Roth IRA. You could roll it into the kids' Roth IRA. So it's very exciting. It's a big change. There are some rules around it. They're a little bit complicated. I'm going to go through them quickly right now. The first one is that there's only $35,000 you can roll over the lifetime. So you can't, and the second part of that is that you can't roll all $35,000 left over in that 529 in a single year. So you're going to have to obey the Roth contribution limits for whatever the calendar year is in that future, at that future date. So that means that this year, if you're under the age of 50, you can put $6,500 a year out of the 529 plan into a Roth IRA until you hit $35,000. If you're over the age of 50, you can contribute $7,500 a year every year until you hit $35,000. Now, you can make that beneficiary whomever you want. So let's say your kid gets through college, they get a scholarship or some sort of aid, or they finish in 3 years, bless their hearts, they're amazing. You've got a little bit of money left over in their college plan, and you just want to give it to the kid. Very generous of you, very nice. They have to have some sort of earned income in order to do this. So hopefully they graduate, they get a job, they got $1 of income, then they can roll $7,500 or $6,500 because they're going to be very young probably. And then until they hit $35,000, and then they've got their Roth 401k plans started. They've started their 5-year clock. They've got a great start to life. Let's say you don't want to give it to them. Let's say you want to give it to somebody else, another grandkid who needs it for college. Just change the beneficiary. Let's say you have all these kids or grandkids, they're all gone out to college or not, and you just want to roll it into your own. Change the beneficiary to you, roll it, obey the same rules. You can do the same thing. The big complicating rule here, and this is where the law isn't clear the way it was written, is that the 529 plan needs to be around for 15 years. For most of us, that's not a problem. It means that likely when a kid or grandkid gets born, we just start a 529 plan. Similar to the Roth clock, you start a 529 clock. You give yourself 15 years, and then you can do whatever you want with it. If the beneficiary changes, it's not 100% clear that a new 15-year clock doesn't start. I think the intent is that they do not start a new clock, that you can change the beneficiary, that you get this thing in place, and then you've got all the flexibility. But that hasn't been written in code yet. And nobody, of course, has done this yet because the law just passed. So there you go. 529 plans just became a lot more appealing. There's a lot more flexibility, a lot of new ways to go tax-free. Okay, there it is. Okay, so relief for workers. Oh my goodness. So these are some big changes for these types of people, and I'm going to go through them fairly quickly because a lot of them won't affect a lot of us. The first one are military spouses. So if you're in the military, you move around a lot. And if your spouse wants to work and does and works for the private sector, and she or he wants a 401k plan, well, the 401k plan may have rules in place that prohibit she or he, the two of them, whoever it is, to contribute money until, maybe a year passes or 2 years passes, and there's vesting rules and all sorts of things like that. So the employer for military spouses is allowed to waive the rules for military spouses. And this year, if they do, then the employer gets a $500 credit. That's pretty exciting, from the federal government for the 3 years, for up to 3 years per military spouse. So there's a motivation to help our military. That's great. The next one is public safety workers. So if you are a public safety worker working in the public sector, you've got a public employer, then you're allowed to pull your money out at age 50. That's much sooner than the rest of the private sector at age 59 and a half. So they made the rules the same this year. They said, if you're a public safety worker working for the private sector, then you also get to pull your money out at age 50. Public safety workers are the obvious, firefighters, policemen, but they also include some of the less obvious, like air traffic controllers. So you might, if you are, or somebody, a family member, you may want to check this box and say, hey, did you know that you can get your money out without a penalty at, almost 10 years before the rest of us? Low dollar gift cards, otherwise known as bribery. The government's made it legal to bribe our employees. So if you are the boss at a company or the HR, or somebody is, and you've got a bunch of people at your company who are not contributing to their own 401k plan and you want them to, you can give them a $5 Starbucks card and convince them, entice them to contribute to their 401k. Hey, contribute to the 401k and, I'll get you a McDonald's. Now, low dollar is up to interpretation. The government didn't say, $100 is too much. And I don't know if $100 is too much. $5 doesn't seem like too much. $20 doesn't seem to me like to be too much. So that's up for interpretation. But in any event, bribery is good in the federal government's eyes, at least in this case. There are a number of exceptions to the early withdrawal penalty. So if you want to pull money out of your retirement plan before age 59 and a half, you have a 10% penalty. But now the list of exceptions is long. There have been some in the past, but I'm just going to go through them. And they're strange. They're very strange. It makes you wonder who the lobbyists were who did this, but they're really important. Some of them might apply to you or somebody you know. The first one is, if you expect to die within 7 years, you're allowed to pull money out of your plan without a penalty. Now, if you don't die, then you have to pay it back within 3 years. I don't know that anybody who supervises this knows anything about when somebody's really going to die. So I think that the limits are open for that. The second one, the limits are written to be open, and the employer has to depend upon the word of the employee. The second one is that you're a victim of domestic abuse. If you're a victim of physical or verbal, or in any way you claim that you're a victim of domestic abuse, the employer has to believe you, and you can pull up to $10,000 or half of the account value. It applies to 401ks and IRAs both. So that's a big one because that's a new rule that went into place. It's the same set of rules though. If you have to pay it back, and you can only do that one time. And the third one is emergency withdrawal. So this is a new complication for employers. You can get $1,000, an employee can get $1,000 out for an emergency. Every 3 years, they're allowed to do that. They do have to pay it back over that 3-year period, or they don't get their next one. So it's not a lot of money, $1,000. It's a lot of paperwork for the employer. So I have a feeling there's going to be a whole lot of computer programmers making this easy behind the scenes for 401k providers to track it for employers. So if employers, you need to be aware that that's on the horizon and you want to find somebody who can help you make that easy. Long-term care, if you need to go to a nursing home or someone in your family does, long-term care, you're allowed, and it's crazy expensive. The dollar limit for long-term care today that you get to deduct is $450, I think. But for a 401k plan or an IRA plan, you're allowed to pull $2,500 out a year if you need long-term care without any sort of a penalty, regardless of your age. It's a strange exception. Most people who need that are well over the age of 59 and a half. But it is one. It is one. All right, so the last bullet is also big. Easing adverse tax consequences. This is a big change. Earnings, if you exceed your contribution limit. So in a 401k plan, you're only allowed to put so much money in. And in the past, there's a pretty onerous penalty if you messed up. Well, you're no longer subject to that 10% penalty. You don't have to worry about it. You do have to fix it right away, though. If you don't fix it right away, then you're in trouble. The second easing adverse tax consequences is for people who retire early. And so as long as you make substantially equal payments, you're allowed to do this. It was called Section 72T. Well, it got complicated when people started doing that with an annuity. And so now annuities and these other ways to provide lifetime income are safe ways to do it. A third one is very big for survivors of the Marshall Fire here in Colorado and the terrible hurricane in Florida. There's enhanced relief for disaster areas, so you can get money out of your 401k plan. This is now a permanent thing. It was a temporary thing, and now it's been made permanently part of the 401k plan. And then finally, the final easing adverse tax consequences is a strange one, but you get a new emergency savings account. So in addition to that $1,000 that pulls out of your retirement account, employers can set up a new $2,500 maximum emergency saving account. It's similar to an HSA, but it's attached to the retirement plan. The money goes in taxable and then comes out tax-free for emergencies. The highly compensated employees, by the way, for all of these exceptions are not eligible. It's only for folks who are under whatever this year's highly compensated rule for income might be. Those were a lot of changes. The big deal here is that not all these changes are bad. That back in the day, you used to expect the federal government to always, every time, be expecting bad news and that tax changes were higher. In the 80s, we had lower tax rates were lowered, but the number of deductions disappeared. Well, this year, this tax rule and the last one, quite frankly, the past couple it's the trend of this decade that the tax rules are actually becoming a little bit more lenient and the deductions are not coming back. So in some ways, it's a little bit better. An example to that is that you've now got higher contribution limits to your retirement plans. So this is a big one. You're allowed to contribute more money into your retirement plans than you have been able to before. And the next thing is that the higher tax brackets as well. So the brackets have gone up. If you were a single person in 2022 and your taxable income was $90,000, you broke into the 32% tax bracket. If you're a single person in 2023 and your income is the same $90,000, you've fallen into the 24% bracket. So that's a nice savings for you. Now, that's an opportunity for you to start thinking about, maybe I want to start to do a Roth conversion or create some more taxable income now while I'm in a temporarily lower tax bracket. Similar math for married couples at $180,000 of income would be the same number. Last year, a 32% bracket, this year, a 24% bracket. Similar for people in even higher incomes that you're threshold to reach that higher tax brackets, the highest tax bracket, went up quite a bit due to inflation. So the changes that happened this year, by and large, benefited the taxpayer. Did not help the coffers of the federal government, except that it's enticing people to contribute money into Roth accounts, which helps the government over the short term, and also entices us to stay employed longer because those required minimum distribution ages are now 73 and 75. Maybe we want to work a little bit longer before we're forced to pull money out. All right, on the website right here, on our website, a great resource for you if you want to see everything summed up in words. Just go to our website, assetsandincome.com, click resources, click Go Tax Free. You'll see the past 3 years of tax bracket information there. You'll see a summary of all those numbers, all those contribution limits in actual dollars. And that's a great resource for you. The last one I want to talk about is just a strange one. I mean, I think a lot of these ones, quite frankly, are strange, but this one's just weird. And I don't really see who benefits from this. I'm wondering who the lobbying group was, and who the lobbyists are who are ages 60, 61, 62, and 63. Because this lobbying group did a great job for people who are age 60, 61, 62, or 63 only. You could contribute 1.5 times as much for your catch-up contribution into your retirement plan than the rest of us. Here's how that works. I call it a cinnamon roll. It's like the opposite of a donut hole. Do you remember many years ago? It's been true for many years, and every year it seems to come up. If you're a Medicare recipient and you spend money on prescription drugs, it doesn't matter whether they're generic or name brand, you get to a certain dollar amount, and Medicare pays for it. But then above that dollar amount, you've got to pay 25 cents on the dollar for all these medicines. This year's dollar amount is somewhere around $4,660. So it's a lot of money. It's pretty expensive. So the donut hole really hurts Medicare recipients who are on very expensive drugs, and many of them, of course, are some of the most vulnerable in America. So the donut hole gets bad press every single year, and it probably deserves it. This is the opposite of a donut hole because it's benefiting a certain small group of people more than the rest of us. For people between the ages of 60 and 63, the year that you turn that year and all those years that you remain that year, not age 64, you lose that benefit. You get to contribute more money, 150% of whatever the required, whatever the allowed contribution limit is. And so this year, if you're contributing to an IRA, you can contribute $7,500 into your IRA at ages 50 to 62. And then magically at age 63, if you were 63 this year, then you'd be able to contribute it'd be another 50% of that. So it'd be $11,250. The other thing that's very strange about the way this rule rolled out is that it's almost kind of mean because it doesn't start until the year 2025. So if you turn age 60 in the year 2025, then you really benefit from this rule. So maybe the lobbying group was age 58 because they've got a couple of years before it really hits. Anyway, it doesn't make a whole lot of sense, but that's the cinnamon roll. The people that age of these magic ages, for whatever reason, get to contribute a little bit more than the rest of us. All right. So let's look at the standard deductions in America. We pay a lot of taxes, but like I was saying earlier, we're losing tax deductions. So that in some ways, that makes life a lot more simple. And a lot of us have chosen just to do the standard deduction. I see more standard deduction conversations with my clients than maybe in a year that I've had in 20 years or more of doing this. And so that's an interesting time, but the standard deductions are higher than they've ever been. So that's a good thing. If you're single, your standard deduction is $13,850. If you're married, it's twice that, $27,700. If you're claiming head of household status, then it's $20,800. For each filer, if you're married, you can double this amount. If you're single, it's $1,500 that you can add if you're over the age 65 or older. So these are pretty big numbers. You're getting yourself close to $30,000 that you can pull off of your taxable income for your standard deduction. And that's pull off your income to get down to taxable income. So that's a wonderful thing that happened this year that I just wanted to point out. So not only did the brackets go up, the standard deductions went up. Most of what changed this year was good for taxpayers. And I'm going to end my prepared remarks right there.